Hello, this is Cryptolyze. I hope you are well on this Saturday, 16 September 2023. It is with pleasure that we meet today to talk BTC, to talk macro. This is a bit like our weekly vision, where today we are going to talk about the inflation figures in the USA, the impact that this will have on the continuation of the possible recession in the USA, this very important notion of soft landing. Are we heading there? In what way? And above all, what is the impact on BTC? What does this recession have in store for us? This soft landing on BTC, you will see that it is still very special, and we will start straight away. So the inflation numbers for the month of August came in. That's it. July and August fell. July 3.2, August fell to 3.7. So we had an increase in inflation. So when we look like that, we can say to ourselves that that's it. It's complicated. Inflation is starting again, implying that the party will have to increase its rates. Is this really the case or not? To do that, you just need to look at the inflation figures and look at the month of August. I think it's important to take a step back to understand where this inflation is coming from. And when we look quickly enough, we will see that inflation is at the energy level versus where we are at 0.601. We see that in August, we are at 5.6. Something that is really very, very strong, mainly driven by classic commodity energy, with gasoline and therefore classic gasoline. So we are really in something that is driven by an energy crisis. What else do we have as an inflationary element? It's interesting to see in the elements that are normally supposed to be the least volatile that we have, yes, a little bit of an increase in inflation. But when we link it again, what do we see? We see that this is mainly said to transport services, which makes sense with the increase in energy, okay? So here we are in a process of saying to ourselves, okay, I am more in a form of contraction of inflation on the elements. Classic, in which we will have, for example, the shelter, we are at 0.3 instead of 0.4. We were 0.8, 0.6, 0.4, 0.6, 0.4, 0.4, 0.3. So we have a reduction in shelter prices. So everything that is linked to the ability to be in a house, whether it is allocation or purchase, at the same time, which is logical with the real estate crisis in the USA, we have already known it for some time, although it manages to persist, that we are in something which is different from 2008, from this, in any case, on the part IMO. So we are in something where we are in a form of contraction in terms of inflation. We even see it in the notion of food. We see that we are in the process of to decrease. We were at 0.3 in July. We are at 0. 2, despite the fact that we had a month of August and a month of July, which were complicated in terms of foodstuffs. We have a wheat, which is currently at its lowest. So we are in areas where normally we should have inflation, which is low. What holds us high? There's no need to think for too long. It's about energy. In terms of energy, we see that it really hurts. And for me, we are in a process where, okay, we still manage to hold inflation mostly when we remove the notion of energy. And what is the notion of energy linked to? It is mainly linked to a geopolitical notion. That is to say that this is an economic conflict between the BRICS, which is linked by OPEC and Saudi Arabia, and Russia on oil energy capacity. We recall that the BRICS, it is more than 56% of energy reserves. So inevitably we are going to have a squabble which will take place, and which has as its basis at the same time and a reinforcement the Ukraine-Russia war. So we are in this process where there is a desire to push the price of oil high, and that is normal. We will see it later in terms of the price. You will see that it's really visible. We'll even look at it right away. We see that we're in an acceleration phase since we broke up with 82, and we're accelerating upwards to get 89 to potentially fetch the 94 or even the $100 mark. Are we going to stay in there for long? Are we going to stay at these very high prices for long, 93 minus 100? Personally, I don't think so. All right, I think that we are more in the process of saying that we are in an acceleration phase because at the same time we have an overconsumption of oil which is underway through Chinese consumption, where we see that they are starting to rise again very strongly. We are behind a reduction in demand by OPEC and Saudi Arabia. Saudi Arabia, which really plays a role in this, where we have a reduction of 1 million barrels and a priori perhaps yet another reduction. But we must understand that Saudi Arabia is at a turning point. They have limited reserves, and we know that they are seeking to get away from this notion of black gold to arrive at an economic cycle which is much more geared and much more diversified towards potentially tourism and elements like that. So we are in a phase of geopolitical transition with a geopolitical economic war, and that is what we are seeing. Will increasing rates change that? The answer is going to be no. Raising rates isn't going to change that. What will change that could be a drastic change in geopolitics? Well, that's going to be a little complicated in any case straight away, but we keep in mind the political change in the USA which will arrive in 2024. Well, political change, that will be seen, but in any case, there will be elections in the USA that could have an impact. We will keep it in mind for the future because you will see that subsequently we will use it. So for me, it's just temporary, that part. But this is not necessarily the case everywhere. That is to say that here we looked at the Fed's version, but if we look at the European version, we will see that it is not the same thing at all. We are really in a totally different approach where we have the energy within itself, which is at 6.2, 6.3 versus 6.7, 6.6. So we are in something which is rather decreasing. We are in an approach that is really different at the European level. Europe is more a truly structural inflation, very strong, very heavy, which is driven by food, which is driven, yes, by energy. But energy has a much less significant share. And at the same time, Europe has started, the ECB has started well late, so I think that the ECB will resume. But hey, for me, we have to understand that we have the United States on one side, on the other Europe on the other side. I am much more mixed about Europe. I have difficulty seeing an end to the crisis straight away, and something that could be in the form of a soft landing. I see it more as a hard landing for Europe. On the other hand, for the USA, I see something that is much lighter, much more supported, and precisely, does the Fed really need to increase its rates further? Clearly, we see that what is being priced by the market is that we are not going to have an increase in rates next week. We are not going to have an increase in rates until at the end of this year, and then we will drive the pivot price from June 2024. Implied, the market will resist until then. There will be no problems, and therefore we will bring about the pivot phase to bring about the soft landing. Soft landing which can go through a recession. And historically, this is a bit of what has always happened when we look at these two curves that I have always shown you for quite a long time, which are in light blue, the Fed rate, and in dark blue, the rate unemployment, which are the two indicators to follow. And the green periods are generally the periods of recession, which are noted, in which we can clearly see that we have the plateau phase in which we maintain the rates, something in which we should arrive. And then from the moment when there is the pivot, so a reduction in rates, we arrive in the recession phase with the increase in unemployment, which increases because we are starting to have defaults on companies. And are we going to succeed in this process? Wouldn't we perhaps arrive at something sooner? That is to say, the pivot accelerates because precisely we have a defect that is being put in place. We must see that here, during this entire phase, normally, when we see the increase in rates, we see unemployment decreasing until it reaches a plateau. So we can clearly see here the fact that we stop the downward trend in unemployment and then we start to rise again. The upward start begins at the time of the pivot. Are we starting to have that here? It's totally different because here we already had the plateau which was formed while the increase is taking place. And we are starting to see the increase in unemployment which is taking hold. So for me, I tend to tell you that we are going to have a pivot, which will perhaps be faster than we expected because we will have an indication in terms of unemployment that potentially we could have defects that will occur, defects that will happen, which at the same time are logical. When we look at the state of household credits here, we see that we have never been at their highest. We are dealing with a population in the USA which is currently over-indebted behind a contractual increase in the use of credit cards, which is once again at its highest. So we are really in elements which are maxed out. That is to say, there are no more savings and we have maxed out the notion of credit. So this means that the purchasing capacity and investment capacity of Americans is at its lowest. That's a bit of the representation we have. And there we are going to make the distinction with this representation. So we are supposed to have a Fed which will pass into a plateau phase, which is logical. We are not going to re-increase the rates because the elements are at their lowest at the current time. And potentially would we not move into a pivot which will be faster because we have unemployment which is rising slightly. This must be confirmed in the next 2 months. To see is what we really have is a trend which is taking place, and we have households which are over indebted. This means that they have much more difficulty in being able to renew their debt capacity with interest rates higher, and that at the same time we will have a reduction in consumption volumes. Where will we find this reduction in consumption volume? We don't have to give it up. We'll find it, for example, on the S&P 500, which is the representation of stocks. And what are stocks? This is the purchase of future profits. Overall, that's it. We pay for the future profits of a company. And if we have a reduction in volumes, which has been compensated until now by an increase in pricing, or even for some, an increase in margins because they have gone like oxen. At a given moment, pricing power, therefore the capacity to be able to increase prices, will decrease. Will stop at the moment when households will no longer have the additional investment capacity, the additional purchasing capacity through credit in the USA. And so this is where we will find ourselves in complexity, and this is where everything will come into play for the notion of self-funding, in the Fed's ability to be able to do two things, and that's important. One, you are going to tell me, yes, lower the rates, I agree with you. We will lower the rates quickly when we have this part. But above all, it will be to manage the oil here, to manage the inflation linked to the energy. How do we manage this? Namely, that oil no longer has production capacity. We are already at maximum production capacity on that side. So it will be after negotiations, which will be geopolitical, it will be political negotiations. And there it is a standoff, which is taking place. We must understand that it is really a very big showdown, because if we maintain very high inflation here and we don't have the capacity to lower rates as quickly as expected, this time we will be in a hard landing, and that will hurt a lot. So everything will actually come down to the ability to manage what? Well, energy, oil once again. Everything is linked to oil. Everything is linked to the ability to be able to use energy to transform this energy, which is the engine of our capitalism. So what will happen to BTC in these two scenarios? First thing, when we already see the S&P 500 where we traced 80%, is this the case at the BTC level? Well, clearly not. We barely retraced 20%. So we are really very far from the movement we had of the S&P 500. That also implies that we have a decorrelation, which is rather logical. I explained it to you for some time, where when we are in a phase of uncertainty, we have a reduction in risk lines for institutional investors. So institutional investors do not buy BTC by default. They buy compound products. And in these compound products, we will have BTC, which represents the volatile part, the risky part of these compound products. Clearly, the exposure to these compound products has completely fallen or even completely disappeared. And currently, these compound products have no interest because we have high rates. So we have yield, which is allowed by American bonds. Therefore, there is no point in seeking volatility to gain yield when you have almost guaranteed yield with U.S. bonds. So as long as this is not resolved, as long as we have not made the pivot, we will always have a decorrelation here. This decorrelation goes both upwards and downwards. Historically, when we fell to the S&P 500 level of 1 point on BTC, we almost fell from 3 to 4 points, or even 5 points in some cases. So we are no longer in this process. For me, even if we arrive in this recession and we arrive in an S&P, which will look for targets that are strong enough in which we will potentially retest the 4,300 to fill this gap, or even much lower look for the 4,200 minus 4,100 points to retest this important level. That's in the notion of a soft landing, in which we have a recession phase, a breather, and then we start to rise again. In a hard landing, it's not the same thing at all. We're going to make a bounce here, we're going to break there, and we're going to potentially retest the lowest in the 3,800, 3,700, and there, on the other hand, we risk having an impact. Clearly, this will be characterized in what way at the BTC level? Once again, I remind you that we have a correlation that is reduced. That does not mean that we have zero correlation. But we will, in any case, decrease. For me, the targets are present here. Soft landing, it's 22.0 and 19.0. So which is my reload and hard landing zone? It's going to be a retest of the lowest. So a retest from 15.0 up to potentially 17.0. So for me, it's really knowing even a small bit, which will look for a lower. Why not just a bit of liquidity? But are we going to get $9,000? I don't think at all, even on a hard landing, because we have this decorrelation, and we are not likely to have a correlation while we are already in a bear market phase. We must understand that we are in a phase where BTC has lost all appeal. It is not interesting. A BTC at 20.0, a BTC at 15.0 has no appeal in terms of yield. Return comes from volatility. Volatility comes from bull running. As long as there is no bull run, there is no volatility. If there is no volatility, there is no return, at least for institutional investors. We have to see this clearly, and this is where BTC will be dependent on several things. One, will be dependent on endogenous elements through regulations, therefore, which will be a very strong element. And there we remember that in 2024, we have geopolitics, which will be impacted by the American elections. And therefore, crypto too, okay? We know very well that the Democratic camp is clearly anti-crypto. If we ever have someone who is much less anti-crypto, even if only Democrat or Republican, then it will be much simpler in the legislative framework, and which is one of the reasons why we support very strongly currently through the SEC, through the CFTC, which is precisely trying to implement a regulatory phase before these 2024 elements. So we are in this process where BTC and crypto in general, we are waiting for the ETFs. We are waiting for the endogenous elements, and we are resisting this part of the recession, especially if it is going to be in a soft landing, a little less, if she is going to be in a hard landing. And this is where I'm going to make an additional distinction to tell you that here it is BTC. But if we think about the crypto concept with a total market cap 3, therefore, which is all the altcoins, even outside the terms, for me, the terms are limited. A little apart, I think that we will suffer much more on altcoins than on here, BTC. And that's why I gave you fairly low targets in the videos I made recently on the golden zones. Because for me in this recession, whether it's small, whether it's soft landing, whether it is in hard landing, we will have behind an impact which will be quite strong at the level of altcoins, much stronger in any case than at the level of BTC, and that BTC risks entering. Perhaps be in a form of additional resilience, and this notion of BTC refuge can play a role. We are going to ask ourselves this question tomorrow. Tomorrow at 8:30, I'm making a video for you on what it takes for BTC to become a safe haven. Is it really feasible? And will this notion of recession allow us to arrive at this notion of BTC refuge? And you will see that it is an answer which is not simple, which really has important elements to understand. For the future of crypto, for the future of BTC, and that's at 8:30. I hope you liked this video. If so, don't forget to leave me a comment. It always makes me very happy. If you have any questions, don't hesitate. I will try to answer them, in any case, as quickly as possible. And leave me a like. That always makes me very happy too. See you at 8:30 for the next video, and I wish you a very good Saturday and a very good weekend.